Welcome to the MUFG Global Markets Podcast. I'm Haley Orr, and I'm joined today by Leanne Rakowitz, MUFG's Head of ESG Coverage in the Americas, and Amanda Kavanaugh, Head of Sustainable Finance in the Americas for MUFG. It's Wednesday, April 20th, 2022. Welcome to the podcast, Leanne and Amanda.
Thanks.
Hi,
Happy
great
to be here.
Leanne, I want to start with you today. Earth Day is coming up this Friday, and the theme for this year is Invest in Our Planet. Can you talk about the significance of this theme?
Yes, Invest in Our Planet, and it's a great theme to bring attention to climate change and energy transition. And the investment needed is a large one. It is estimated that financing the transition to net zero will cost $150 trillion over the next 30 years. But by investing in climate solutions now, we could help limit global temperature rise and the extent of further worsening of extreme weather events and ecological damage, and the negative impacts of all of this. These climate risks are financial risks, and the financial community has been increasingly focused on climate change, energy transition, and the risks and opportunities related to them, and that's expected to continue.
Yeah, and it'd be great if you could elaborate a little bit on that. It seems like the financial community, as you said, has been very focused on this. We're also seeing a lot of focus from the regulatory community. So can you help us take stock of everything that's been happening over the past several months and year?
Yes, there's been a lot of progress over the past year, and broadly speaking, in response to investor and stakeholder interest, we saw much more organized collaboration and convergence of reporting standards, and also that regulatory push across the world for disclosure around ESG, particularly climate. So in the US, from a regulatory perspective, the SEC proposed a comprehensive set of disclosures on climate-related risks, and regulators are also interested in how banks are managing climate risks and its implications for the financial system. And then on the reporting front, the IFRS Foundation created the International Sustainability Standards Board, which will form a global baseline for ESG disclosures. A lot of the voluntary standard setters were rolled into that, and they are tackling the climate disclosures first. And also formed over the past year was the Task Force on Nature-Related Financial Disclosures, the TNFD, focusing more broadly on environmental matters and risks and opportunities around nature. And we should see several iterations of their guidance over the coming year. And then on the financial institution side, we saw the formation and growth of GFANZ. So GFANZ is a number of net zero alliances for banks, asset owners, managers, insurance, committed to decarbonizing the real economy to net zero by managing their businesses and portfolios around that, and also engaging with clients and investee companies on decarbonizing. We saw a lot of institutions joining GFANZ over the past year, especially during the run-up to COP26. And over the next year, there should be more and more details from these institutions with regards to interim targets and their plans to meet them. So as a result of all of this, issuers have had more and more pressure to disclose emissions, set targets, and discuss their strategy to decarbonize. And more broadly and outside of these net zero alliances, we're seeing more integration of ESG into financial analysis.
Thanks for that, Leanne. Certainly a lot for us to keep track of. Amanda, I want to turn it over to you, and I want to make sure that we're understanding the market implications of all of these developments. What trends have you seen in the market broadly over the past several months, and what should we expect for the rest of this year?
It goes without saying that we've seen incredible growth in ESG, especially in the debt markets over the past several months and really over the last 12 months. Highlights have included more investor focus and dedicated ESG money, which has led to more issuers and a diverse group of issuers accessing the bond market across the rating spectrum to issue ESG debt. We saw growth in the sustainability linked product. So on the bond side, that has certainly filled a gap for transitioning issuers or those that are infrequent and are having a hard time finding enough spend to meet the benchmark requirements. On the loan side, linked features are being built into many new facilities, and conversations are happening with pretty much every borrower that we're speaking with. For the remainder of 2020, I still think a number of these key themes will continue to hold, even though we are experiencing some volatility recently. I think this year we finished with ESG transactions, especially in the investment grade space, representing a slightly higher percentage of total issuance than last year's 90 billion or 6% of total. We will continue to see growth in both ESG, high yield, and EM transactions. Sustainability linked bonds will take up more market share. The continued focus on the S and the G as well as the E, and then an enhanced focus on disclosure and transparency. And we're starting to finally see a path towards standardization here with the SEC proposed climate-related disclosure announcement in recent weeks.
Amanda, you mentioned the recent market volatility. How has the ESG bond market specifically been impacted by the broader volatility we've seen in the market of late?
Even though we are experiencing volatility right now, ESG transactions are continuing to get priced. The ESG transactions are following the broader market in that right now the windows for issuance are opening and closing rather quickly versus what we've become accustomed to in months past. Year to date, the investment grade bond market has priced 30 billion, which is just under 6% of total IG, while high yield and high yield EM has priced nearly 10 billion, or a third of all of last year's total. In the investment grade market, though, we are seeing some inconsistencies, though, when it comes to achieving a greenium. Greeniums have really come into focus over the course of 2021. That's not to say that they won't return. However, right now, it is a little bit more of an investor market versus issuer market. That being said, the order book sizes for ESG transactions have continued to be larger than we've seen on plain vanilla transactions, highlighting that investors are still showing a preference for ESG transactions, even if spreads are not compressing as much as before. The diversity of issuers is certainly welcome. We've seen issuers in the industrials, healthcare, telecom, and consumer product spaces bring ESG paper. Again, a nice respite from financials, utilities, and REITs. The green label is representing just over half of issuance, while sustainability and sustainability linked continue to grow in market share. I'm certainly optimistic that we'll continue to see a large group of issuers bring ESG transactions to the bond market.
So it sounds like we're still seeing advantages of ESG issuance, even if the greenium is less pronounced. Can you speak a little bit about the loan market and any trends that you're seeing there?
Sure. The ESG loan market right now is unfortunately down compared to last year. That being said, this is not necessarily related to the current macro backdrop and just the fact that we saw large volumes over COVID and 2021. That being said, we are talking to many borrowers about the sustainability linked feature for upcoming facilities.
Great. Well, certainly a lot of developments from the regulatory side, from the investor side, and from the market side. I appreciate both of you joining us today.
Thank you.
Thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.